In the world of central banking and global markets, something significant is happening. As we move into the second half of 2025, the world's major Western economies aren't moving together. Instead, they are taking three very different paths. One is slamming on the brakes, another is just taping the accelerator, and the third is flooring it, trying to outrun the threat of stagnation. This isn't a coordinated recovery. It's a great economic schism driven by stubborn inflation, surprising economic strength, and some aggressive policy gambles. For businesses, investors, and all of us at home, figuring out this divergence is the key. It's what will determine who wins, who loses, and who gets left behind in this uncertain new reality. Hi everyone, this is George, and today we are going to break it all down. We will look at the conflicting economic signals and classic policies in the United States, the United Kingdom, and the Eurozone. We will explore the mix of hope and fear in each region to give you a clear picture of what the global economy will look like in July 2025. The global economy is being pulled into two main directions. On one side, you have the looming threat of a trade war, with new tariffs that could disrupt supply chains and push up prices. On the other hand, you have central banks making completely different bets on how to handle this situation. The result is a fractured and unpredictable environment where the old rules just don't seem to apply here. So, who is actually in the best position to succeed in this new world? The answer isn't simple. The story of the American economy right now is one of sharp contrasts. There is a real fear of a major slowdown, but it's clashing with the stubborn reality that inflation just won't go away. After a period of strong performance, the US economic engine is clearly sputtering. The first quarter of 2025 was a shock. Real GDP actually contracted. The first time that's happened since early 2022. This wasn't just a blip. It was caused by a surge in imports as companies rushed to stock up before the new tariffs hit, combined with weaker spending from consumers. Forecasters now see a clear slowdown, with predictions for 2025's full-year growth slashed to between 0.8% and 1.6%. That's a huge step down from the solid 2.8% growth we saw last year. The summer slowdown economists who support that during the summer months there is an economic slowdown, were worried about what seems to be happening as the temporary boost from all that stockpiling wears off, revealing that underlying demand is weaker than it looked. This slowdown is expected to hit the job market too. Monthly job gains are predicted to slow down to a crawl in the second half of the year, maybe just 25,000 a month, and the unemployment rate is expected to creep up, possibly hitting 4.6% by the middle of 2026. So, that's the fear. The complicating factor in all this is inflation. The Federal Reserve's fight against rising prices is nowhere near done. Its preferred inflation metric, the core personal consumption expenditure, the PCE price index, is stuck at 2.7% and is now forecast to hit 3.1% for 2025. This inflation is being supercharged by the very tariffs meant to change trade policies, which are expected to make things more expensive for consumers all summer. This toxic mix of slowing economy and sticky inflation has put the Federal Reserve in an impossible spot, while other central banks are starting to cut rates, a policy that I don't really agree, to be honest. The Fed's hands are tied. It has kept interest rates in a restrictive range of 4.25% to 4.5% for several meetings now. Officials don't want to cut rates and risk another inflation wave. So maybe only one small rate cut is on the table for the rest of the year, although the Fed said that there might be two rate cuts. So who wins and who loses? There aren't many winners. A strong dollar propped up by high interest rates helps importers and American tourists. People holding cash and short-term bonds are getting great yields. But the list of losers is really long. Businesses, especially in manufacturing and construction, are getting hammered by high borrowing costs. Consumers are getting squeezed from both sides: high rates on mortgages and credit cards, and higher prices at the store. The stock market might be near record highs, but that's hiding a lot of uncertainty. The American economy is walking a tightrope with no safety net underneath. Across the Atlantic, the UK's economy looks different, but it's just as complicated. The story here is one of surprising strength, bumping up against some serious long-term weaknesses and problems, actually. Against all odds, the British economy started 2025 with a bang. GDP in the first quarter jumped by 0.7%, its best performance in a year, beating many other G7 countries. This growth, mostly from the services sector, offered a bit of hope that the economy might finally be turning a corner. But this optimism is already fading. The strong first quarter growth isn't expected to continue, with forecasts for the full year pointing to a more modest expansion of around 1% to 1.2%. A big reason for this is a problem of its own making: fiscal tightening. Recent hikes to the minimum wage and employer national insurance contributions, while good for workers, are squeezing businesses, especially those that rely heavily on their staff. This is putting the brakes on investment and, of course, hiring. And yes, the ghost of Brexit is still around. Lingering trade problems with the European Union, the UK's biggest trading partner, are a constant drag on productivity. Some studies show that the higher cost of trade have ironically helped less productive companies survive by protecting them from competition, which hurts the UK's growth potential in the long run. The government has a new trade strategy to cut some of this red tape, but the challenges are still huge. When it comes to inflation, the UK is in a tricky spot. The headline consumer price index at 3.4% is still well above the Bank of England's target of 2% and is expected to rise to 3.7% by September. But unlike in the US, there are signs that core inflation is starting to cool off as wages growth slows. This has led to a major split in policy. While the Fed is holding steady, the Bank of England is signaling a change. Policymakers are divided, but markets are expecting a rate cut in August, with more to come by the end of the year. This suggests that the Bank of England is willing to live with slightly higher inflation to keep the fragile recovery from dying. For the UK, it's a precarious balancing act. The winners here are exporters who could benefit from a weaker pound if rates are cut, and investors in UK stocks which are offering good dividends. This is the reason that you see the FTSE 100 exploding these days. A new veterinary deal with the EU is a clear win for smaller food and agriculture businesses that were hit hard by Brexit bureaucracy. The losers are the businesses squeezed by higher labor costs and less government support, as well as consumers still dealing with a high cost of living. The UK isn't in a recession, but its recovery is on a shaky ground, and it's very sensitive to both policy decisions at home and shocks from abroad. So over the channel in continental Europe, the economic story for July 2025 is the most positive of the three. It's about a cautious recovery being driven by decisive actions. The Eurozone seems to be winning its fight against inflation, and that victory has opened the door to a completely different policy path. The big news is on prices. Headline inflation in the Eurozone fell to 1.9% in May, finally dipping below the European Central Bank's 2% target. This was thanks to a sharp slowdown in services inflation and has allowed the ECB to declare a tentative win. With inflation seemingly under control, the ECB has turned its full attention to growth. It's taking the lead among major Western central banks by cutting its key deposit rate to 2% in June, with another possible cut after its July meeting, but we will be here to discuss it. This aggressive move is designed to support an economy that, while getting better, still has some underlying weaknesses. This policy support is working. The Eurozone economy grew by a solid 0.6% the first quarter of 2025, its best showing since late 2022. The recovery is being helped by rising real incomes, strong job market and more government spending, especially in Germany, and on defense and infrastructure projects across the bloc, although I don't really agree with this policy. The ECB is forecasting GDP growth of 0.9% for 2025, with things expected to pick up a bit more in 2026. But this optimism comes with a big dose of caution. The fear for the Eurozone is twofold. First, the recovery isn't the same everywhere. The overall strength of the bloc hides big differences between member countries, and structural problems are still a long-term issue. Second, the Eurozone is very exposed to global trade disputes. The threat of more tariffs from the United States is a major risk for the continent's export-heavy economies, with some analysts suggesting a severe tariff war could slash GDP growth. So overall, who are the winners and losers here? The main winners are consumers and businesses inside the Eurozone. People have more spending power as their real incomes rise with falling inflation. Businesses, especially smaller ones, benefit from lower borrowing costs, which should boost investment. The ECB's proactive policy is a clear win for short-term stability. The main losers are on the currency front. Cutting rates so aggressively pushes down the value of the euro, making imports more expensive. Also, the recovery's benefit might not be spread evenly across all 20 member nations, which could create even bigger economic gaps within the bloc itself. While the Eurozone seems to have the best policy mix right now, its success is still vulnerable to outside shocks it cannot control. This back and forth between monetary policy and economic data is reshaping our world in real time. If you want to stay on top of these critical shifts and understand what's driving the global economy, make sure to subscribe and turn on notifications. I also give frequent updates on my X account, which I will link in the description below. When we step forward and look at the global economy in July 2025, the picture is one of a deep and growing split. We are not in a synchronized world. The United States is caught in a trap, forced to keep tight policy because of stubborn inflation, even as its economy slows down. The United Kingdom is walking a tightrope, carefully trying to ease policy while dealing with structural issues and less government support. And the Eurozone is making a bold dash for growth, leading the pack in cutting rates now that it has inflation under control. There is no single winner here in this fractured environment. Instead, there are winners and losers within each region, depending on how exposed they are to interest rates, inflation, and trade. The main takeaway is that the era of a one-size-fits-all approach to the economy is over. Global risks, from trade wars to geopolitics, are now seen through three very different economic lenses, creating a complex and unpredictable future. The reasons for hope and fear are tangled together more tightly than ever, but the pattern looks different depending on where you are in the world. So, in terms of markets, overall what we expect to see is maybe a volatile American stock market, which has rising pressures as the Fed is expected to cut rates, but also faces contractionary pressures as the economy might hit a stagflationary path. For the UK, we will most likely see a falling sterling and a rising stock exchange as the markets are adjusting for the rate cuts. For the EU, the situation is almost the same, with rising stock markets and a falling euro. Getting through the second half of 2025 will mean understanding this new divided reality. See you all on Thursday for a new opinion video on what is economics. And no, it's not just supply and demand, markets, income, and expenses. Stay tuned. See you all. Bye bye.